What is going on YouTube? Welcome back to the channel. For those of you that are new here, my name is Afzal Hussain. You can find out a bit more about me through the social media links below, or you can check out my website, which is www.afzalhussain.com. In this video, we are going to be talking about what exactly is a hedge fund, because oftentimes a lot of students hear about this term and they don't really know what exactly it is, and so when you Google search it, you get a whole array of different definitions and terms, and in this video I just want to give it to you plain and simple and explain what it is. In essence, a hedge fund is basically a pooled investment vehicle. Now you're probably wondering, what on earth is a pooled investment vehicle? So let's actually just break down the term hedge fund. You've got hedge, which in financial terms simply means to protect yourself in times of uncertainty, and then you've got fund, which is basically a pooled investment vehicle, which is collating different sums of money from different individuals, putting them into something called a fund and using that to invest in the financial markets. If you've seen some of my other videos, you might have heard me mention the term asset classes. So asset classes are areas in the financial markets which you can invest in. So there's fixed income, there's equities, there's multi-asset, there's quant, and there's alternatives. When we talk about hedge funds, they fall into the alternative investment bucket. A few very common hedge funds that exist out there include Soros, Oxif, Bridgewater Associates, Citadel, and if you want to find out a bit more about them, I would highly encourage you to go and search them on Google, check out their websites, see the different strategies that they use to invest, see what they're about, find out a bit more about their history, and that will help you kind of find out a bit more about those individual companies in the hedge fund space. Historically, the reason why hedge funds have become very notoriously known for taking risky bets in the financial markets is because hedge funds can take investment positions or bets in both directions. So they can go long or they can go short. Mutual funds, so more safe or less risky investment funds as opposed to hedge funds, can only invest long. The mutual funds tend to be regulated, and so that means they are limited in the way that they can invest. And hedge funds, this is one of the main features of them, they aren't really regulated by the Financial Conduct Authority, the FCA, which is the financial markets regulator. And so hedge funds are allowed to take positive bets on companies or financial securities or instruments, and they can also take negative bets. So what that means is if they think a company is going to be performing very badly, they can negatively invest in that company. So they can create bets that assume that that company is going to perform very poorly over the next few months or years, and so they can invest short and invest long. As a result, that gives a lot of opportunity for investors to kind of hedge themselves. So remember, we mentioned the word hedge, it means to protect yourself. So if investors are facing a very rough market environment, they might use hedge funds as investment vehicles to protect themselves from going both long and short. Having said this, it's important to note that some hedge funds are specifically long only hedge funds, so they might only focus on long strategies or positive growth strategies in the equity markets. Some hedge funds might specialize in real estate investments, some hedge funds might specialize in the debt markets. A hedge fund, broadly speaking, doesn't do a bit of everything. It might have a specialty, and so it's always good to know that different hedge funds focus on different things. Another reason why hedge funds are often considered to be risky is because they take on a lot of leverage. Now what that means is, in order to maximize their returns, they invest with borrowed money. So let's say I'm a hedge fund and I only have £100 million to invest. If I believe that the opportunity is going to give me a 2% return or a 5% return, on my 100 million I might get 102 million or 105 million. But if I borrow money and use that debt to invest, so if I borrow another 100 million and then I use that 200 total to invest and I get 5% return, that makes 210 million pounds. Now then I give back the initial 100 million and some profit from that, but because I borrowed that money, invested it and made a stronger return, I get more money simply by borrowing that money from various clients. Now having done this, it provides a bigger risk, because if the market went the opposite way to what I thought it would, the loss would have been bigger. So when you lever up, or when you take leverage, when you try and maximize your returns by borrowing money, the upside is bigger, but the potential risk is that there is a bigger downside. And hedge funds tend to do this a lot, and so that's why they are considered very, very risky. A lot of investors like hedge funds because In times of low returns in the financial markets, when the different asset classes are giving you 1 or 2%, you can go to a hedge fund who will tell you they are seeking 5 to 10, 11, 12, 13% returns. And if you're willing to take that risk, then, you know, if it suits your risk appetite, you can pursue those higher returns at the risk of potentially losing as much. One of the reasons why hedge funds aren't regulated is because they can only take money from accredited investors who are meant to know what they're doing or where they're investing their money. And so the regulators don't need to worry about what the hedge fund is doing because it's taking money from people who know what they're doing. Accredited investors, or people who can invest in hedge funds, usually have a net worth of over £1 million, and each investment size is usually a minimum of £200,000. So if you're wondering if you and I can invest in hedge funds, the answer is probably no, because individuals who invest in them have net worths of over £1 million, and each investment size is over £200,000 on average. In addition to that, it's usually large institutions who are investing alongside them. Many of you will probably be wondering, how do hedge funds make their money? So they follow this rule for the most part, which you might hear called 2 and 20. What that means is they receive a 2% management fee and a 20% performance fee. So let's say I'm a hedge fund and I ask lots of investors and clients to give me £100 million, and that £100 million I'm going to charge 2% on per year. So that's the management fee. In order to manage that money and invest that money, I'm going to charge them 2%. Now the 20% fee, the performance fee, comes in when, let's say, I am promising a 5% return. If we hit 5%, anything above 5%, I get to charge them 20% on. So it gives me incentive as the hedge fund manager to try and outperform or try and get the best returns possible, because up to 5%, I'm only getting 2% management fees. Any returns above 5% will get me a 20% management fee. So it's in my interest and the client's interest to abide by a 2 and 20 management fee and performance fee structure. It's, you know, not uncommon for a lot of investors to want to be involved with hedge funds, and a lot of hedge funds to want to be involved with investors, because the returns are, you know, very lucrative and can be very, very large if the bets are played or invested correctly. And that's a basic overview of what a hedge fund is, how it operates, what are the fee structures, and the clients that it serves. If you found that video useful at all, it would mean a lot to me if you can give this video a thumbs up. Let's try and smash 500 likes on this video. And if you haven't already, make sure you subscribe to the channel. I do a weekly video every Wednesday. And if you are subscribed, please turn on post notifications so you never miss an upload. If you've got any video suggestions or comments, leave them down below, and I will see you in the next video. Peace!